paradise has a price tag, and for millions chasing the Hawaiian dream, that bill just became impossible to pay. While tourists snap selfies at Waikiki Beach and glossy photos of ocean real estate agents post front properties, a financial earthquake is tearing through the islands. Home values are plummeting, buyers are vanishing, and entire neighborhoods are watching their equity disappear faster than morning mist over Diamond Head. The numbers tell a story no vacation brochure wants you to see. Median home prices that once seemed untouchable are now free-falling across Oahu, Maui, and the Big Island. Properties that commanded seven figures just months ago sit empty on the market, their asking prices slashed by hundreds of thousands of dollars. Local families who scraped together life savings for down payments now find themselves trapped underwater, owing more than their homes are worth. But this isn't just another market correction. This is a complete unraveling of the paradise economy, driven by forces that go far beyond simple supply and demand. Insurance companies are fleeing the islands, mortgage rates have climbed to levels that price out entire generations of buyers, and the very policies meant to protect Hawaiian communities are instead destroying their wealth. What started as whispers among real estate agents has become a full-blown crisis echoing through every corner of island life. From luxury condos in Honolulu to modest single-family homes in Hilo, no property type and no price range has been spared. The dream of owning a piece of paradise is becoming a nightmare for thousands of families who thought they had secured their future. The warning signs were there for anyone willing to look past the palm trees and perfect weather. Monthly mortgage payments that once fit comfortably into middle-class budgets have doubled, sometimes tripled, as interest rates soared from historic lows to levels not seen in decades. A modest home loan that cost $1,500 a month in 2021 now demands over $3,000, pushing homeownership beyond the reach of teachers, nurses, firefighters, and the essential workers who keep island communities functioning. Insurance premiums have exploded across the Hawaiian Islands, driven by mounting concerns over natural disasters and climate risks. Annual policies that once cost a few $1,000s now routinely exceed $10,000, with some waterfront properties facing bills that rival their mortgage payments. For many homeowners, the combined burden of insurance, property taxes, and loan payments has crossed the line from challenging to impossible. The luxury market, once considered bulletproof, is showing the deepest cracks. Million-dollar listings that previously sold within weeks of hitting the market now sit stagnant for months, their prices cut again and again as sellers grow desperate for any offer. Oceanfront condominiums in prime locations are being marked down by $200,000, $300,000, even $500,000 as reality sets in that the old pricing models no longer work. But the pain extends far beyond high-end properties. Starter homes that represented the first rung on the homeownership ladder for young families have become completely unattainable. The mathematics of qualifying for a mortgage, when combined with Hawaii's already astronomical cost of living, simply don't add up for most residents. Grocery bills that consume a third of household income, gasoline prices that lead the nation, and utility costs that dwarf mainland averages leave little room for housing payments that have reached absurd levels. Inventory is flooding the market at unprecedented rates. Active listings have surged across all major Hawaiian markets, creating a buyer's market that would have been unthinkable just 2 years ago. Properties that once received multiple offers above asking price now struggle to attract a single qualified buyer. Real estate agents describe showing after showing where interested families walk through homes, fall in love with the space and location, then walk away when they see the true monthly carrying costs. The rental market, traditionally a safety valve for those priced out of home ownership, is providing no relief. Landlords facing their own financial pressures from rising insurance and maintenance costs are passing those expenses directly to tenants. Monthly rents that already consumed the majority of local incomes have continued climbing, creating a squeeze that forces families to choose between housing and other basic necessities. Investment activity, once a driving force in Hawaiian real estate, has largely evaporated. Mainland investors who previously competed aggressively for island properties are redirecting their capital to markets with better risk-adjusted returns. Short-term rental operators, squeezed by new regulations and declining tourist demand, are liquidating portfolios that no longer generate positive cash flow. The speculative money that helped inflate property values during the pandemic boom is now fleeing just as quickly as it arrived. Local businesses are feeling the ripple effects as the real estate market contracts. Construction companies that thrived during the building boom are laying off workers and canceling projects. Mortgage brokers, real estate agents, home inspectors, and the entire ecosystem of professionals who depend on property transactions are watching their incomes disappear. The economic multiplier effect of a collapsing housing market extends into every sector of the Hawaiian economy. Young professionals and recent graduates are making a painful calculation that previous generations never faced. The islands where they grew up, where their families have lived for generations, are no longer financially viable for starting careers and building futures. The brain drain that results when educated young people leave for more affordable mainland markets represents a long-term threat to Hawaii's economic diversity and cultural continuity. Retirees who plan to spend their golden years in island paradise are discovering that fixed incomes cannot keep pace with the true cost of Hawaiian living. Social Security benefits and pension payments that seemed adequate when making retirement plans now fall woefully short of covering housing, health care, and basic expenses. Many are making the heartbreaking decision to abandon their Hawaiian dreams and relocate to states where their retirement dollars stretch further. The psychological impact of watching home values plummet is taking its toll on communities across the islands. Families who viewed their homes as their primary source of wealth and security are coming to terms with paper losses that represent decades of savings and investment. The stress of being financially trapped in properties they can no longer afford is affecting marriages, mental health, and the social fabric of neighborhoods that once embodied the spirit of aloha. Government officials are scrambling to address a crisis that threatens the very character of Hawaiian communities. Affordable housing programs that were already inadequate are being overwhelmed by demand from families who never expected to need assistance. Zoning reforms and development incentives that might have helped in normal times seem insufficient to address the scale and speed of the current collapse. The perfect storm battering Hawaiian real estate shows no signs of subsiding. Multiple forces are converging to create conditions that challenge every assumption about island property values and the sustainability of the current economic model. Understanding how we reached this point and what comes next requires examining the specific factors that transformed paradise into a financial trap for so many island residents. The mechanics of Hawaii's housing collapse reveal themselves in devastating detail when you examine the numbers district by district. On Oahu, where nearly 70% of the state's population calls home, median home prices have tumbled from their pandemic peaks in ways that would have seemed impossible just 18 months ago. Properties in Kailua that commanded $2.5 million are now listed at $1.8 million, representing losses that wipe out entire retirement accounts overnight. The Big Island presents an even starker picture of market devastation. Homes in Kona that attracted bidding wars during the remote work boom now sit vacant for 4, 5, even 6 months without a single offer. Sellers who purchased investment properties expecting steady appreciation are cutting asking prices by $300,000 or more. Desperate to escape monthly carrying costs that exceed rental income by thousands of dollars, Maui's luxury market has become a cautionary tale of speculation gone wrong. Oceanfront estates that sold for $8 million in 2022 are now priced at $5.5 million, yet still attract no serious buyers. The wealthy mainland investors who once competed fiercely for trophy properties have shifted their attention to markets where insurance costs don't threaten to consume 20% of the property's annual value. Property insurance has emerged as the single most destructive force reshaping Hawaiian real estate. Companies that provided coverage for decades are either raising premiums to impossible levels or simply refusing to write new policies altogether. Homeowners lucky enough to maintain coverage face annual increases of 40, 50, even 60%, turning insurance from a manageable expense into a budget-breaking obligation. The withdrawal of major insurance carriers has created a cascade of problems throughout the housing market. Lenders require proof of coverage before approving mortgages, but finding that coverage has become increasingly difficult and expensive. Some properties, particularly those in areas prone to lava flows or coastal flooding, have become effectively uninsurable at any price, making them impossible to finance through conventional means. Cash buyers, once a reliable source of demand in Hawaii's high-priced market, are reassessing their risk tolerance as insurance costs spiral upward. Purchasing a $1 million property only to face annual insurance bills of $50,000 or more represents a return on investment that no longer makes sense. The smart money is flowing toward markets where natural disaster risks don't require such extreme financial hedging. Mortgage mathematics have turned brutal for Hawaiian families trying to enter the housing market. A typical home loan of $700,000 that would have carried monthly payments of $3,000 at pandemic-era interest rates now requires over $5,000 at current rates. That extra $2,000 per month represents more than many island families earn in gross income, effectively locking out entire demographics from homeownership. First-time buyers face particularly harsh realities in today's Hawaiian market. Young couples earning the median household income for the islands discover that qualifying for even a modest starter home requires monthly payments that consume 70 or 80% of their take-home pay. When combined with Hawaii's elevated costs for food, transportation, and utilities, the financial equation simply doesn't balance for most working families. The construction industry, once a pillar of Hawaiian economic activity, is experiencing its own version of market collapse. Builders who started projects during the boom years are now completing homes that cannot sell at prices sufficient to cover construction costs. Some developments have been abandoned mid-construction, their half-finished structures serving as monuments to misplaced optimism about sustained demand. Material costs that skyrocketed during the pandemic have remained elevated, while labor shortages continue to drive wages higher for skilled trades workers. The combination means that new construction costs often exceed what buyers are willing or able to pay for finished homes. This fundamental disconnect between production costs and market prices has brought development activity to a near standstill across the islands. Existing homeowners trapped in properties they can no longer afford are making increasingly desperate decisions. Some are attempting to convert single-family homes into multi-unit rentals, hoping additional income streams can offset crushing monthly expenses. Others are selling personal possessions, tapping retirement accounts, or borrowing against life insurance policies to maintain payments on homes that have become financial anchors. The vacation rental market, once a lucrative alternative for property owners, has largely collapsed as both regulatory pressure and economic reality squeeze operators from multiple directions. New restrictions on short-term rentals have eliminated many properties from the legal vacation rental inventory, while declining tourist spending has reduced nightly rates and occupancy levels for those that remain operational. Properties purchased specifically for vacation rental conversion are being liquidated at massive losses, as owners recognize that the business model no longer generates positive returns. Condominiums bought for $600,000 with expectations of earning $4,000 per month in rental income are being sold for $100,000 after generating losses month after month. The psychological toll of financial stress is becoming visible throughout Hawaiian communities as families grapple with the reality that their homes may never recover the value they once held. Neighborhood barbecues and community gatherings carry undertones of anxiety as residents share stories of mounting bills, impossible insurance renewals, and the growing possibility that paradise may no longer be affordable for people who have called it home for decades. Professional service providers who built businesses around Hawaii's once thriving real estate market are adapting to a dramatically different landscape. Real estate agents who routinely closed million-dollar transactions are now competing for a shrinking pool of qualified buyers. Mortgage brokers who processed dozens of loan applications each month are lucky to see a handful of deals that actually reach closing. The ripple effects extend into every corner of the Hawaiian economy as reduced real estate activity translates into fewer jobs, lower incomes, and decreased consumer spending. Restaurants that relied on real estate professionals for lunch business are seeing empty tables. Retail stores that counted on commissions from property sales are experiencing declining revenues as their customer base faces financial pressure. Yet beneath the statistics and financial devastation lies a more fundamental question about the future of Hawaiian society. When housing costs price out teachers, police officers, healthcare workers, and other essential professionals, communities lose the diversity and stability that make neighborhoods function. The hollowing out of the middle class threatens to transform Hawaii from a place where families build lives into a playground accessible only to the ultra-wealthy. The state government faces impossible choices as tax revenues decline alongside property values, creating a budget crisis that threatens essential services. Property tax assessments that once provided reliable income streams are being challenged by homeowners whose properties have lost hundreds of thousands in value. Schools, hospitals, and infrastructure projects that depend on real estate tax revenue are seeing funding evaporate just when communities need support most. Local banks and credit unions are tightening lending standards as they watch loan portfolios deteriorate in real time. Financial institutions that once eagerly competed for Hawaiian mortgage business are now requiring larger down payments, higher credit scores, and more stringent income verification. Some lenders have stopped writing new loans altogether in certain high-risk areas, effectively redlining entire neighborhoods based on insurance availability and natural disaster exposure. The foreclosure pipeline is beginning to fill with properties from families who simply cannot maintain payments in the face of doubled insurance costs and elevated mortgage rates. Unlike previous housing downturns, where strategic defaults were common among investors, these foreclosures represent genuine financial hardship among long-term residents who exhausted every option before losing their homes. Bankruptcy filings are climbing as Hawaiian residents face the harsh reality that their largest asset has become their greatest liability. Families who refinanced during the boom years to access home equity for renovations, education, or business investments now find themselves owing far more than their properties are worth. The negative equity trap has snared thousands of homeowners who cannot sell without bringing cash to closing. Real estate agents are abandoning the profession in unprecedented numbers as transaction volumes collapse and commission income disappears. Brokerages that operated multiple offices across the islands are consolidating locations and laying off support staff. The few agents who remain active are competing fiercely for the handful of motivated buyers still capable of qualifying for financing. Title companies and escrow services that processed hundreds of closings each month are now operating with skeleton crews as deal flow dries up. Some smaller firms have closed entirely, unable to sustain operations when monthly transaction counts have fallen by 70 or 80% from peak levels. The infrastructure that supported Hawaii's real estate boom is being dismantled as quickly as it was built. Construction workers who migrated to the islands during the building frenzy are now leaving for mainland markets where opportunities still exist. The exodus of skilled labor will make future recovery more difficult and expensive as the workforce that built Hawaii's housing stock disperses to other regions. Contractors who specialized in high-end custom homes are PIV and repair work just owing to maintenance to stay afloat. The vacation rental industry continues its death spiral as new regulations combine with economic headwinds to eliminate profit margins. Properties that generated $5,000 monthly in gross rental income now struggle to cover basic operating expenses as nightly rates fall and occupancy levels plummet. Insurance increases alone have wiped out the profitability of many vacation rental operations. Homeowners associations across the islands are facing their own financial crises as special assessments and maintenance costs climb while property values decline. Condo buildings that deferred maintenance during the boom years now need major repairs and improvements at the worst possible time. Association fees that were already high by mainland standards are increasing by hundreds of dollars monthly as boards try to address neglected infrastructure. The psychological impact of watching neighborhoods empty out is taking its toll on remaining residents. Streets that once buzzed with activity now feature multiple for sale signs and vacant properties. Children are losing classmates as families relocate to more affordable states. Community organizations that relied on volunteer participation are struggling to maintain programs as stress and uncertainty consume people's time and energy. Local businesses that catered to the real estate industry are reinventing themselves or closing permanently. Furniture stores that sold to new homeowners are liquidating inventory. Home improvement retailers are cutting staff as renovation projects get postponed indefinitely. The entire ecosystem of businesses that thrived during the housing boom is contracting rapidly. Professional services beyond real estate are feeling the squeeze as their client bases shrink. Attorneys who specialized in real estate transactions are shifting to bankruptcy and foreclosure work. Accountants who helped clients structure property investments are now helping them navigate tax implications of short sales and deed in lieu arrangements. The legal and financial advisory sectors are adapting to serve clients in distress rather than clients building wealth. Hawaii's unique geographic isolation, once a selling point for property investors seeking exclusive markets, has become a liability as transportation costs and supply chain disruptions add layers of expense to every aspect of homeownership. Shipping building materials, appliances, and household goods to the islands costs significantly more than mainland alternatives, making property maintenance and improvement projects prohibitively expensive for cash-strapped homeowners. The state's dependence on tourism revenue creates additional vulnerability as economic uncertainty reduces visitor spending and occupancy rates at hotels and vacation rentals. Local residents who supplemented their income with tourism-related work are losing those opportunities, just as housing costs reach crisis levels. The convergence of declining tourism revenue and collapsing real estate values threatens the foundation of Hawaii's entire economic model. Energy costs that already ranked among the nation's highest continue climbing, adding another burden to homeowners struggling with mortgage and insurance payments. Monthly utility bills that routinely exceed $300 for modest homes represent a significant portion of household budgets already stretched thin. Solar installation projects that might reduce long-term energy costs require upfront investments that most families cannot afford. Food costs in Hawaii, always elevated due to shipping expenses and limited local production, have reached levels that force difficult choices for families allocating shrinking budgets between housing and basic necessities. Grocery bills that consume 40% of household income leave little flexibility for families facing unexpected housing expenses or income reductions. The healthcare system is beginning to show strain as medical professionals leave for more affordable markets and remaining providers face their own housing cost pressures. Hospitals and clinics that struggle to recruit and retain staff in the best of times are finding it nearly impossible to compete with mainland salary offers when the cost of living differential has become so extreme. Educational institutions from elementary schools to the University of Hawaii are losing both students and faculty as families relocate and professionals seek opportunities in more affordable regions. The brain drain that results when educated residents leave represents a long-term threat to economic diversification and community stability. Public transportation systems that were already limited are seeing ridership changes as residents make housing decisions based partly on commuting costs. Families priced out of areas near employment centers are moving to more distant locations, increasing transportation expenses and time burdens that further complicate household budgets. The environmental movement, that has been a cornerstone of Hawaiian identity, faces new challenges as economic pressures force difficult trade-offs between conservation goals and immediate financial needs. Families struggling to afford housing may have less capacity to support environmental initiatives or make sustainable choices when those options carry premium costs. Cultural preservation efforts are threatened as native Hawaiian families and long-term residents are priced out of their ancestral communities. The displacement of local populations by economic forces represents a continuation of historical patterns that have shaped Hawaiian society for centuries. Community leaders worry that the current housing crisis will accelerate the loss of cultural knowledge and traditional practices. Youth sports leagues, community centers, and cultural organizations that depend on volunteer participation and donations are finding both harder to secure as families focus on economic survival. The social infrastructure that binds communities together weakens when residents are under extreme financial stress. Religious congregations are seeing members leave for more affordable states, while those who remain face reduced tithing capacity and increased requests for financial assistance. Churches that once served as community anchors now struggle to maintain facilities and programs as their financial foundations erode. The arts community that has long been a source of Hawaiian cultural expression is particularly vulnerable, as creative professionals often work in lower-paid occupations that cannot support current housing costs. Galleries, theaters, and music venues are losing both artists and audiences as the cultural economy contracts, along with the broader financial crisis. Small business owners who invested their savings in commercial properties are facing the same underwater mortgage situations as residential owners. Restaurants, retail stores, and service businesses that borrowed against real estate equity during the boom years now find themselves trapped by debt loads that exceed current property values. The fishing and agricultural communities that represent some of Hawaii's oldest economic traditions are under pressure as land costs make traditional livelihoods unsustainable. Families that have worked the same land for generations are being forced to sell to developers or investors, breaking connections to place and practice that span centuries. Construction of new affordable housing units has slowed to a crawl as developers cannot make projects pencil out at current cost levels. Government programs designed to encourage affordable development are proving inadequate when basic construction expenses exceed what target income levels can support through mortgage payments. The rental market continues tightening as property owners exit the business rather than deal with negative cash flow situations. Families seeking rental housing find fewer options available, while rents on remaining properties continue climbing to cover landlords' increased expenses. Property management companies are consolidating or closing as the volume of rental properties under management shrinks and profit margins disappear. Professional property management that once provided stable income streams for investors is becoming a loss-making proposition in many market segments. Insurance adjusters and claim specialists are seeing increased activity as desperate property owners file claims for any covered damage that might provide financial relief. The frequency of insurance claims is rising, even as coverage becomes more difficult to obtain and more expensive to maintain. Moving and storage companies report increased business as families relocate to more affordable mainland markets. But the businesses themselves face the same cost pressures that are driving their customers away. The irony of facilitating Hawaii's population exodus while struggling with their own viability is not lost on industry participants. The luxury goods and services sector that flourished during the real estate boom is contracting rapidly as high net worth individuals redirect their spending toward more essential expenses or simply leave the market entirely. Jewelry stores, high-end restaurants, and luxury service providers are closing locations or reducing operations. Even the funeral industry reflects the broader economic distress as families struggle to afford traditional burial costs while simultaneously dealing with housing-related financial stress. The full spectrum of Hawaiian life is being reshaped by the collision of impossible housing costs and stagnant incomes. Real estate professionals who built entire careers around Hawaii's property market are making gut-wrenching decisions about their own futures. Agents who earned six-figure incomes during the boom years are now working part-time retail jobs to supplement dwindling commission checks. Brokerages that employed dozens of agents have shrunk to skeleton crews, with many experienced professionals abandoning the industry entirely rather than compete for the handful of deals that still materialize each month. The domino effect reaches into every corner of professional services that supported the real estate ecosystem. Home inspectors who once booked appointments weeks in advance now sit idle as transaction volumes evaporate. Appraisers find themselves delivering valuations that reflect harsh new realities, often 20 or 30% below what homeowners expected. Title companies that processed hundreds of closings monthly are laying off staff and consolidating offices as deal flow collapses. Mortgage brokers face particularly brutal conditions as lending standards tighten and fewer buyers qualify for financing. Professionals who specialized in creative financing solutions during the boom are now explaining to clients why conventional loans have become impossible to secure. The few transactions that do move forward require extensive documentation and multiple approval layers that didn't exist during easier credit conditions. Hawaii's real estate collapse represents more than market correction. It's the systematic dismantling of the island dream that has defined paradise for generations. From Waikiki to Hilo, the evidence is undeniable. Insurance costs that rival mortgage payments, home values slashed by hundreds of thousands, and families forced to abandon communities their ancestors called home for centuries. The question isn't whether recovery will come, but whether Hawaii can remain home to anyone beyond the ultra-wealthy when the dust settles.